I'm delighted to welcome Oya Celesun here. A number of you will remember she was here about 6 months ago. Oya has a master's degree from Valiant University in Ankara and a PhD from University of Maryland, and is a long-serving member of the IMF, has worked in many countries, and is now division chief of the World Economic Outlook Studies division in the research department, and as such is responsible for the WEO forecast, which hits the front page headlines when it disappears. And we're very lucky she's coming to talk to us about the latest forecast, and particularly two special subjects which are on it, including, I think, going to focus on climate change. So it's the short term, as the title of the talk is, the short term prospects, and then what's going to happen in the medium term. And I hand it over to you.
Thank you very much for the very kind introduction, and I really am happy to have the opportunity to talk here. So I will be giving an overview of the World Economic Outlook that we launched in October, and I will give a very brief overview of the forecasts, the outlook, which hasn't changed so much since I was here in October. It's definitely stronger, but the tone is, qualitatively, it's pretty much the same. So I'll focus on the themes we had, which is one of which is on wage dynamics in advanced economies, and the other one is how low-income countries, how and whether low-income countries can adapt to climate change. Okay. So just to give an overview of the what's happening with global growth, what we've seen in the last 6 months successively is that growth is gaining further momentum. The second half of 2016 had stronger growth than the first half, and the first half of this year had even stronger growth, and we see that continuing. We expect a bit further picking up in 2018. And we have advanced economies and emerging market economies which are doing slightly different things, although growth is picking up for both groups. In advanced economies, the stronger growth we have right now is mostly of a cyclical nature. So many of these economies are still operating somewhat below potential. They are now growing more than potential and closing their output gaps. However, if you look ahead a few years to the medium term, what we expect is that growth will slow down as the cyclical boost wanes. There are headwinds against growth there, one of which is population aging and slower growth in the labor force, an issue that we have started to study, and we probably in 6 months that's what we're going to be talking about. So somewhat stronger growth in the near term, but some slowdown expected in the medium term. That's the picture for advanced economies. For emerging market and developing economies, the picture is quite a bit more diverse. So you have a number of economies that are emerging from recessions that they were in the last couple of years, and they are the ones that are boosting growth for the group as a whole. You have China, where growth is still very strong but slowing going forward. And then you have a lot of different types of cases where you have mostly domestic issues determining the growth path. For example, the recoveries in Brazil and Russia. Behind this picture, we have inflation that remains quite subdued, surprisingly subdued, something that I will focus on in this talk. Turning to the risks, in the near term, they appear balanced. If anything, we may see stronger growth in the near term. Data has been coming in quite strong. Confidence, manufacturing output expectations are quite strong. Financial conditions are very favorable. So that suggests that in the near term, we're likely to be right or even proven a bit pessimistic. But in the medium term, we still see risks to our outlook as being tilted to the downside. There are threats out there that mean that it's more likely that we may have to revise down going forward than up. And turning to the policy priorities, our usual sort of flow, it's not very different than what we discussed last time. Given the differing cyclical positions, macroeconomic management needs vary a lot across countries. but a common goal with advanced economies expected to slow down in the medium term and emerging market economies themselves facing many challenges is to boost growth potential through supply side reforms. So just let me emphasize one more time that as we revised our forecast up, we've done this against a backdrop of very favorable financial conditions. Running up to this forecast revision, the 6 months running up to this forecast revision, equity prices gained quite a lot. They are shown by the blue bars here in this chart. And that's coming on top of the gains in the 6-month period before that, which are shown in the yellow dots. And if anything, in advanced economies, ever since we closed the forecast, we've seen further gains. So equity markets have been very buoyant. Emerging market economies, again, is a much more diverse picture, but generally it has been favorable there as well. And bond yields have sort of moved in the opposite direction. They had risen in the run-up to our spring forecast because the US, which is an economy that is where output is closing in on potential, the output gap is shrinking, was expected to shift towards a more stimulative fiscal policy, and that was leading to expectations of higher inflation and higher bond yields. So some offsets, a bit of an automatic stabilizer for the growth boost. But what has happened since then is that expectations of fiscal stimulus in the US have faded quite a bit. Now it's coming back again. And inflation has generally surprised on the upside. Even though we've had real activity surprise on the upside and unemployment decline more than we expected, inflation, including core inflation, has been coming in weaker than we thought. Together with that, you've had lower bond yields. So when you put those together, better growth, lower yields, equities, further gains, it's quite a favorable backdrop for growth at the moment. Just to give a very quick overview of the numbers, I won't go into the country details, but for the world as a whole, growth was 3.2% in 2016. That's in purchasing power parity terms. So growth is being aggregated using purchasing parities rather than market exchange rates. And that 3.2 was the slowest growth pace we've had since the global financial crisis. The US didn't do so well last year, and several relatively large economies like Brazil and Russia were contracting. So we had that weak growth rate. And now for 2017, what's expected is around 3.6. So that's quite a meaningful pickup. And a little bit further of a gain is expected for next year, mainly coming from emerging market economies. So the good news was that, in particular for advanced economies, many euro area economies where output gaps were quite clearly negative, like Italy, Brazil, growth surprises have been on the upside, and we've been marking up growth. So that has been the most favorable part of the story, that the revisions were really where we would like to see them. In general, advanced economies have been quite uniform. Most have had upward revisions. The UK and the US are exceptions here. In the US, that has to do with lower expectations, more diminished expectations of fiscal stimulus. Otherwise, data has been coming in actually quite strong. For the UK, it's the fact that growth has been surprising somewhat on the downside, and past growth has been revised as well. So it suggests somewhat weaker growth momentum with quite a bit of uncertainty as to growth going forward. Elsewhere, it has been mostly positive. For emerging market economies, it's the picture as you'll see the revisions, those two white rows in the bottom show positive and negative numbers. So it's a much more diverse picture. But growth is picking up there as well, and in a more sustained fashion. Unlike the advanced economies, which are closing their gaps and then slowing down, here it's expected to continue somewhat going forward. This is happening even though China is projected to slow down. We've actually revised our growth forecast up for China. Policies are remaining quite stimulative, and going forward, our team expects the support to continue more than it did before. That's, however, coming with higher downside risks looking out to the medium term, because credit and public debt are growing quite fast. India has had a markdown because of more idiosyncratic reasons. The currency exchange initiative and the introduction of the global sales tax, good initiatives for the medium term, but in the near term they have created some uncertainty. The good news is that Brazil and Russia, which both had sharp contractions, especially Brazil, where output contracted by about 7% over 2 years, had upward revisions. Growth has come in a bit better, and inflation is very weak in both countries, numbers that we wouldn't have expected to see a few years back, which is allowing central banks to be more accommodative, and that's also helping growth. Now turning to the last two columns, when you look at Africa, however, the picture is quite different. It's mainly in the commodity exporting economies of the region, especially fuel exporters, that you see quite weak growth, because there's still a fiscal adjustment going, and more to come in view of weaker terms of trade. And in South Africa, political uncertainty is also weighing on the growth outlook. So risks, more broadly, I think I briefly mentioned this. The main areas here to think about are financial tensions, a few of them, threats to global economic integration, which have diminished over the last few months, but still the underlying pressures for more protectionism haven't gone away. Another area is persistently low inflation in advanced economies. It may be supportive in the near term because it has allowed central banks to maintain more accommodative policy than otherwise. But for the medium term, it's not healthy to emerge from the recessions, if you wish, or the cycle with weak inflation, because it reduces the scope to ease policy if needed later, when needed later. Then we have a bunch of non-economic factors. I will be talking about one of them, climate change. But also, in many parts of the world, very difficult political conditions are weighing on growth, and geopolitical tensions are also present. Now, on financial tensions, a few areas I just mentioned the financial stability risks in China. Policy efforts have been stepped up there, so you see a slowdown in credit within the financial sector, but not yet much of a slowdown in terms of credit to the real sector. So that is posing some risks. Global financial conditions, we just mentioned that financial conditions in advanced economies and many emerging market economies have been very favorable, and volatility is at record low levels for the last 20 years. So these conditions have never lasted for very long, and there's a risk of a rapid reversal, which could take away some of the momentum in private spending. And that would also mean risks of capital flow reversals to emerging market economies, which have been quite buoyant since the start of the year. And it's a worry that if those conditions change, we would have to mark our growth rates down going forward. But so far, so good. Okay, policy is not much change from last time, so I can go over that very quickly. Cyclical conditions demand continued support in many advanced economies, especially with inflation being weak. Potential output needs to be strengthened, is expected to slow down. Now that the recovery is in train, attention also has to shift towards tackling debt burdens, public debt burdens, which have been growing since the global financial crisis. So that's sort of the next chapter in fiscal policy. For emerging market and developing economies, it's a much more varied picture across countries. For many economies, taming the credit cycle in China is very important. China is a major consumer of commodities, so changes in growth in China can have ramifications for a whole set of countries. many of these economies are still adjusting to the loss of commodity revenues, such as the fuel exporters. Financial risks, with the risk of financial conditions changing rapidly, micro and proactive macroprudential policies are very important. Conditions are favorable, but that may not last. And finally, structural reforms to boost potential output are no less important there in many of them, especially those that have to diversify their economies in the face of lower commodity revenues. So a few things on this otherwise bright outlook. For advanced economies and for commodity exporting emerging markets and developing economies, growth may be picking up in the near term in some of them, but the medium term outlook is not very bright. We mentioned that. In fact, in about 1/4 of emerging market and developing economies, per capita incomes are not projected to be above advanced economy levels in the next 5 years. So it's a relief that we're going from weak growth rates in 2015-16 in the aftermath of the commodity shock, but there are quite serious challenges ahead. Especially now that the advanced economies' per capita growth rates are not very strong, this is not a very strong bar to clear. And, depending on your ambition level or how you see it, it's not a very bright story for many of them. And the other concern is that, as we mentioned, underlying inflation rates remains puzzlingly low in advanced economies, which also raises some questions about the sustainability of the outlook. Okay, just a few charts on convergence. Here you see the heterogeneity in per capita growth rates, with demographic trends quite diverse across countries, across advanced economies and emerging market economies, and within emerging market economies. It's important to not just focus on headline growth, but also look at per capita growth as well. So we are, in our team, increasingly putting an emphasis on that. So the chart on the left shows you, on the two left groups, shows the per capita growth rates in the past 2 decades and what is expected going forward. The expectations are the yellow bars. And you can see how, for advanced economies, per capita growth is falling short of what it was in the decade leading pretty much up to the global financial crisis, 95 to 2005. Per capita growth was 2.2% then. It's projected to be 1.4% now. And that's not that's a pretty growth rate. It's of course better than the decade which contained the financial crisis, but it's in a context where median household incomes have grown much less than headline per capita growth rates. It's a situation where ensuring that everybody sees some improvement in their living standards is quite a bit more difficult with such a low per capita growth rate. And in some cases that is behind this diminished expectations are behind these inward-looking policy pressures. I think 20, 30 years ago, families expected to double their income in a dramatically shorter period than they do now. So that's why for advanced economies, it's still quite important to take those structural reform measures, which are admittedly very varied across countries, to boost potential growth at a time when growth is actually strong, as it is right now. For emerging market and developing economies, the diversity is really enormous. You see in the third group the per capita growth rates of China slowing down quite considerably from very high levels, but still very strong compared to the rest of the group. And then the next two set of bars splits the rest of the emerging market universe into two groups, fuel exporters and importers, excluding China. And it's really in the fuel exporters where you see growth weakening considerably. In fact, for the median country, you don't have any growth expected going forward for the next 5 years. And the right group of charts just shows the regional diversity with emerging Asia, emerging Europe, and countries in the Commonwealth of independent states doing quite a bit better than Latin America, the Middle East, and Sub-Saharan Africa, which are all regions that contain many commodity exporters. This is the same chart, but also showing the range, the interquartile range for countries. And again, in the for the fuel exporters group, you see that, and in many countries in Middle East and Sub-Saharan Africa, you actually have starkly negative projected real per capita growth rates. So all in all, we mentioned 25 countries are not seeing convergence over the next 5 years, and that makes up about 5% of the population, 20% of the population of that group lives in countries that is not seeing catch-up. And this is coming on the back of quite varied demographic trends, as I mentioned. It's really in Sub-Saharan Africa where you see a big pickup in the share of working age population as relative to the total population. So the demographic dividend is starkly ahead for them. You actually have, by 2035, 400 million people being expected to be added to the working age group in Sub-Saharan Africa. So that's an opportunity, of course, for these countries to catch up towards advanced economy income levels, but it's also a challenge to use this period in a way that ensures that this happens. The right-hand chart shows that by 2050, about 20% of the world's working age population will be in Sub-Saharan Africa. And if you look beyond that, towards 2100, it's close to half of the working age population. And the left-hand side chart shows that you have that very prolonged trend of upward trend in working age population in Sub-Saharan Africa. To some extent, you have that in India and other groups as well, in the Middle East and North Africa for sure. But at the same time, you have a very rapid aging process in China, where that share drops quite precipitously over the next 50 years, and the same for advanced economies, where it's really happening in the next 20 years or so. So it's really in this context that one has to think about whether the per capita growth projections we have are satisfactory or not. Now let's turn to our other puzzle, or our other worry, which is subdued inflation. On the left-hand side, you see the chart for advanced economies, headline and core inflation, and on the right-hand side, in emerging market and developing economies, the same inflation rates, headline and core. In general, it's fair to say that inflation has been quite weak and has surprised on the downside everywhere. It's not just advanced economies. Even in many emerging market economies, inflationary pressures are really missing. And in advanced economies, it's really quite below core. Core inflation is quite a bit below the target. The left-hand side shows that just for selected economies. The UK is an exception here. Following the depreciation of the pound, inflation has actually picked up. But pretty much everywhere else, especially if I had included September here, you see very subdued inflation rates. And behind that is also the sort of failure of wage growth to pick up, even as unemployment rates have declined. So that's what the right-hand side chart shows. You see the growth rate of wages in the blue line and unemployment rates in the green line on an inverted scale. So green line moving up means that unemployment rates are declining. These are weighted averages, so averages across countries weighted by country size, country GDP. And you see a relatively tight relationship, at least co-movement between wage growth and unemployment. until pretty much 2013-14. Not perfect, but then after that you see a real divergence. Unemployment has been coming down, and wage growth has not been really picking up. So that was the topic of one of our analytic chapters this time. I just want to walk you briefly through the analysis. So again, on the left side, you see the picture on unemployment. I had just shown you a weighted average. Here you see the ranges. But it's fair to say that it's, in most countries, it's somewhat above where it was in 2007, on the eve of the crisis. At the same time, you had a pretty strong pickup in labor force participation. So that's the antidote to the aging story. People are shifting slowly into older age buckets, but in many countries you actually had participation going up for prime age females in particular. And that's providing some offset, but all in all, in many cases, participation has gone up. Putting the two together, somewhat higher unemployment but somewhat stronger labor force participation, which is sort of the denominator for the unemployment rate, you see that employment rates have pretty much around half of economies have returned to the employment population ratios that are above, stronger than their 2007 levels, and half of them are below. So it's a broad picture of sort of healing in labor markets. But wage growth has been really quite weak, about 2.5% weaker than it was in 2007, and generally much weaker than, when you take the average for the 2000s before the crisis. It's been quite weak since then. One other dimension of labor markets, which we didn't used to look at much before but are becoming increasingly important, is the share of part-time workers. So the chart on the left shows the share of part-time employment that is involuntary, where workers say they would have wanted to work for longer hours, but they can't find that type of employment. So when you look at that metric, it's also stayed quite elevated since the crisis. It hasn't come down much. It was remarkably tighter before the crisis, but there has been a trend underlying this. Quite a common trend, quite a long-standing trend of people working fewer hours on average. That continues, and it's the part that's involuntary that has picked up. Okay, so I'll just walk you through our analysis as to why wages are growth. One check we did was to look at whether shifts across sectors, workers shifting from one sector to the other, has tilted wage growth to sectors where wage growth was always weak. And the answer was no. It's really within each sector, not shifts across sectors. It's weakness within every sector that's behind this. However, if you look at the share of part-time employment, there you do see sectoral shifts playing a role. So more services, less manufacturing, less construction has been associated with this trend of more part-time employment. So we, of course, ran some Phillips curve regressions for wage growth on the usual suspects like inflation expectations proxied by lagged inflation, unemployment rates, and trend productivity growth. And you do get the expected coefficients. There's quite a strong relationship between real wages and nominal wages and productivity growth, not one-to-one. Workers have captured less than the full amount of labor growth and labor productivity over our estimation period, but it's still a tight relationship, and higher unemployment tends to weigh on wage growth. Also, when you look at involuntary part-time employment, splitting the sample in different ways, you also see that it tends to weigh on wage growth. So these are basically the main and quite conventional driving forces for wage growth. And then we asked, okay, how much of the weakness in wage growth can we explain by these factors? And here in this chart, we see the decompositions. We split our sample into 3 groups. In some of them, like the group on the left, unemployment rates are actually lower than they were before the crisis. So that's where labor markets appear to have healed even more. There you see that most of the explanation comes from weaker productivity growth. So employment has been growing, but output has not grown much faster, or in some years hasn't grown much faster than employment growth at all. So it's been quite a period of slow growth in labor productivity, and that has translated, that can do a pretty good job of explaining why wage pressures are quite weak in these group of economies. On the on the chart, on the rightmost chart, you see the case of the countries where unemployment rates are appreciably above, more than 1.5%, I believe, above the 2000 to 2007 average. So that's where labor markets have not healed that much. And there you see the combination of headline unemployment and the involuntary part-time employment share explaining much of wage weakness. Those are the yellow and the green bars. In this group, productivity growth is also weighing on wage growth, but much less. These happen to be the countries where productivity had not picked up so much in the pre-crisis period to begin with. So you don't have much of a slowdown, and you don't have much contribution coming from that. The middle group is quite puzzling. There you do have the residuals, the gray bars. You also have productivity growth and to some extent slack weighing on wage growth as well, but we are doing a not as good a job explaining wage dynamics in that group as we do in others. But all in all, it's really, you can get quite far when you look at all the sample. You can explain 2/3 of the weakness in wage growth by these standard determinants, reproductivity and slack. But it's important to make note of the fact that headline unemployment rates are no longer sufficient to capture the whole slack that exists in labor markets. We have to look at a broader set of measures, including on hours, to understand the extent of slack and downward pressures. We also did an exercise, which is not shown here, to look at common factors. So if we take out the commonality in these driving forces, to what extent is there a common component in the weakness in wage growth? And it was, we found that there are global factors, they are statistically significant, and they've had a downward trend over the last 15 years. So there's also this part that we cannot explain. It's not an idiosyncratic factor that's in a few countries, but in general, there's a commonality to it. And especially, it has been quite weak the last couple of years. So by construction, this is the part that's not explained. It's orthogonal to the factors that we are controlling for. But one possibility is that when there's slack everywhere, and there are threats of relocation, producers can move from one country to the other. The impact of slack on wage pressures is amplified. So there's more, when you have more synchronized slack, the effect of slack implicitly is larger. And we heard quite a few anecdotal stories about wage negotiations in one country being informed by wage negotiations in another country. Swedish workers, when they're bargaining, they are affected by how the wage negotiations are panning out in Germany because of these increased threat of relocation. You don't see a pickup necessarily in production relocation, but the threat of it is there. Okay, we did look at what is correlated with this involuntary part-time employment share, which we found to be to have explanatory power. This is not a causal regression, but just to give some stylized facts as to where, what are the attributes of the countries where this has picked up more. And perhaps not so surprisingly, it coincides with places where expected growth has declined more. So relative to the pre-crisis, if growth expectations have declined more, you typically have a greater pickup in the involuntary part-time employment share. The other variable that was statistically significant on the right up there is the extent of the shift in the employment towards service sectors. So it's possible that now our expectations are that slack will over time diminish. We are seeing that right now. Growth is above potential, unemployment is declining further. So at the end of this process, we would expect wage pressures to pick up. But the fact that you have some slower moving factors driving this involuntary part-time employment share, the fact that the nature of jobs is changing, a shift towards fewer hours, more temporary contracts, these pressures could also keep on weighing on wages for a longer time than we expect. In the forecast, you see core inflation returning to target in the US next year, in Europe over the next 5 years, in Japan outside the forecast horizon, but the slower moving factor just suggests that there's downward risk for that. Okay, so now that we've covered the more near-term issues, just wanted to take the opportunity to turn to the third chapter we had in the forecast, which is more about the long term. It's about global warming and how temperatures and weather shocks more generally affect economic performance. So it's, as I mentioned, it's one of the medium-term risks we see for the global economy. So here's a chart that shows how the global temperature has evolved over the last more than 20,000 years. It's a pleasure to be able to have, we focus quite a bit on the near term, so it was nice to have a somewhat broader view in this chart. So the point we wanted to make here was that there have been periods, scientists are estimating that there have been periods where temperatures have crept up. Most mammoths, well, all by now, mammoths have gone extinct anyway. But the speed of warming over the last 100 years has been unprecedented. Ever since the Industrial Revolution, and especially in the last century, we've had the globe warm by more than 1 degree centigrade, which is a very rapid pace. And the projections are that this is expected to continue. I will just momentarily explain where the red and yellow estimates are coming from, but you can see that it's going to be a very sharp jump in the global temperature. So these are the remission concentration patterns, I believe the acronym means. It's produced by the International Panel on Climate Change. So these are, again, scientists' estimates on how much the global temperature will change in the next, by the end of this century. And it's very much dependent on, these are contingent scenarios, and it depends very much on the extent of emissions. So the RCP 8.5 scenario is this unmitigated climate change scenario. So in that scenario, there is no effective effort to curb greenhouse gas emissions. And RCP 4.5 is an intermediate scenario. It's not very different from what we would get under the existing commitments to curb greenhouse gas emissions, I should say. The COP25, so not existing, because some countries have changed their pledges. So that under that scenario, you would have temperatures going up by about 2 percentage points by the end of the century. Now, before we turn to the macroeconomic impact, just a word on what is causing this. Why did I say it's contingent on greenhouse gas emissions? Scientists have also looked at how much of the change in the temperature over the last, since 1880 I have here, can be attributed to human activity or natural causes. And to be able to explain the upward shift in temperatures, you need to include the human causes. The natural causes themselves don't give you much of an increase. So it's there's very broad consensus that much of the warming we have observed is coming from human activity. Now, what will these higher temperatures do? That's our main question from a macroeconomic perspective in this chapter. But just a few points. One thing that will happen is that extremely hot days are going to become much more common, and natural disasters are also going to become more common. So here you have some selected types of events: tropical cyclones, heat waves, and wildfires, and all of them are expected to become more common in all types of economies: advanced, emerging market, and developing economies. Now, being macroeconomists, our primary concern was to ask, so how is this increase in temperature going to affect economic activity? And there's quite this is an intense area of research. There are papers looking at this. It's a case where it's an exogenous shock, so you can, with quite a bit of confidence, call this an causal. The estimates are causal. It's not any one country that's causing global warming. So when you regress growth on temperatures, it's an exogenous shock. What the literature is finding, and what we've confirmed in this chapter by lengthening and broadening the sample, is that the effect of higher temperatures on GDP per capita is nonlinear. So up until an annual average temperature of about 13, 14, 15%, you have warming being beneficial on output. But once you cross that threshold, it starts to hurt growth. So the inflection point, as I mentioned, is about 13 to 15%. Now, to make projections country by country, since this is a nonlinear relationship, you have to look at where you are initially, what your starting point is. Is this going to put you over that optimal point? Are you already much below or much above? Here, it's interesting to look at the picture, to combine this picture here, which is where you have the estimated curve, the relationship between per capita income and temperature on the red curve, and the marginal effect shown in the blue line, solid line, with an uncertainty band around it. It's interesting to combine this with histograms for annual average temperatures for the three groups: advanced economies, emerging market economies, and low-income countries. And the interesting point here is that for advanced economies, the majority, or about half of them, are already in countries where the temperatures are below optimum. But when you look at emerging market economies, and especially developing economies shown in the red curve, the bulk of them are already in hot climates. So for them, the marginal effect becomes quite a bit below zero, negative. So in this map, we summarized the numeric estimates for what a 1% degree warmer globe would do to growth. And you see a lot of diversity. Advanced economies and some emerging market economies are shown in green, and sub-Saharan Africa, especially the Sahel region, Brazil, much of Latin America, and Asia, South Asia, are red. So they are expected to see output shrink. Now, the other interesting point here is that even within countries, you have diversity. This was estimated using very fine grid cell data, where you split the world into fine grids, looked at temperatures in each grid, and for each country you weighted these grids by population, the population that lives there. So for the US, for example, on the whole, you don't see a significant effect. In fact, for advanced economies where temperatures are below optimum, meaning that warming is not going to necessarily harm them based on these estimates, much of those effects are statistically insignificant, so it's about zero. But there are parts of that country, for example, where the effects are actually negative. So there's a lot of within country regional diversity as well. Another thing to note is that not so many people live in the parts of the world where warming is going to be beneficial on annual income. When you size the countries with their populations, it's really, you see that 60% of the world population today lives in parts of the world where higher temperatures are going to be harmful. And by the end of the century, that share actually goes to 75%. So much of the population in the world stands to lose from this. The other point is that these effects are not just the effects I showed you in the maps are contemporaneous effects. But when you trace out the effects over time using the estimates, they don't go away. In fact, for low-income economies, they seem to deepen a little bit. Statistically, the immediate effect is not that different from the effect 7 years from now, which is the longest horizon we've used, but they definitely don't diminish. Okay, this is again, on the left-hand side, you're seeing that advanced economies, the point estimates are above zero, so some estimated beneficial effect, but they are not actually statistically significant. Emerging market economies and low-income countries see long-lasting effects. And there's actually a debate in the literature as to whether we can interpret this slightly downward sloping line for low-income countries as being a growth effect rather than a level effect. So do these effects actually deepen over time? But it's an open question. For us, what we took away is that the initial and the 7-year effects are not that different from, statistically not different from each other. When you look at sectors where this is coming from, it's actually quite broad-based. The service sector seems to be sheltered from higher temperatures, but manufacturing is not. Agriculture clearly is negatively affected. These estimates are for the countries where the effects are significant, but it's also manufacturing where you see negative effects. What we did in this paper was also to look at what the channels might be for these effects. There were some, unlike the overall growth effect, for sectors there were pieces of evidence, a lot of studies that zoom into one sector only or one country or a few countries only. We put everything together and used all the data we had for our quite large sample, almost 180 economies, maybe a bit less for this exercise, for these estimations. And one channel we found was that labor productivity goes down in heat-exposed sectors. So in the series of charts that I'm going to show, it's perhaps makes sense to focus on the low-income country block, for which we found the most negative effects. And here you see that in non-heat exposed sectors, you don't see much variation in labor productivity, but for heat exposed sectors, you do. When you look at investment, it's also quite depressed in emerging market and low-income countries after a heat shock. These impulse responses are, again, tracing out the effects of 1 degree centigrade more in average annual temperature. This could be one reason why we see lower labor productivity, but it doesn't seem to be the only story, given that you see differences between heat-exposed sectors and others. Another factor is that higher temperatures also have an effect on health, also helping to explain the labor productivity story. Infant mortality is this classic indicator of health, which is measured for quite a period of time for many countries, hence we focused on that. And again, in advanced economies, you don't have significant effects. In emerging market economies, you do, but barely. But for low-income countries, you do see significant effects. And they are building up over time, which is suggesting that it's the weaker economic performance, lower incomes, lower investment that is coming hand in hand with temperature shocks. One question that people ask is whether, as the warming process continues, it's an upward trend in temperatures, which has been going on visibly, especially in the last 30, 40 years. Could this bring adaptation? Could countries get used to being in the heat, and could they take measures? Could they build infrastructure that attenuates the effects? And when you split the sample to answer that question and do your regression successively, comparing effects in the last 20 years with the earlier 20 years, our data starts in 1965, you don't see much of an effect. So there's not much hope that in the near term there will be this automatic adaptation. The effects haven't weakened. Okay, the next question we asked was whether national policies and having buffers on hand could make a difference. And you do see that they can make some difference. On the left-hand block, you see what you can achieve by having stronger buffers. These are the effects of the shock. Again, 1 degree centigrade more on output. And you see that having lower debt, having more, well, not reserves, having lower debt, having more aid inflows, and having more flexible exchange rates do help to attenuate the effect a bit. But you also see that these effects go away over time. So they help to smooth consumption, but it's not a very large effect, and it's not very long-lasting. On the right-hand block, you see you see a measure of other more structural types of policies. So having a deeper domestic financial sector, for example, should in principle help you to reallocate resources as needed when you have a shock. Temperature shocks, as we've seen, are just another kind of macroeconomic policy shock. So some of the attributes that help countries adapt to shocks could help here as well. And for these types of policies, stronger domestic financial system, more infrastructure, more democratic institutions, less inequality, in other words, being a more developed economy does help, and these effects are longer lasting. So there is some scope for countries to protect themselves by just proceeding with the usual recommended set of reforms. But they can go only so far. They definitely don't undo the effects. And one thing to note is that in terms of adaptation capacity, people have looked at how much adaptation capacity different types of countries have, which is a metric based on several attributes: institutional strength, buffers, etc. And it's low-income countries that have the lowest capacity. And turning to who has contributed to this warming, who has contributed to global greenhouse gas accumulations, it's really not low-income economies. They have been very small contributors to emissions. It's really advanced economies and increasingly emerging market and developing economies that have contributed to this. So, in other words, it's low-income countries that are suffering disproportionate impacts to a problem that to which they have contributed very little. And adaptation policies can help to some extent, but their capacity to adapt is very limited. So in other words, it's essential that the international community plays a key role in helping these countries cope with climate change. It's a major challenge, and it's a negative externality imposed on them. And all in all, I mean, these disasters, there's a degree to which you can protect yourself from disasters, but you cannot insure yourself against them fully. It's really emissions, curbing emissions, that can make a material difference there.
That's it. Thank
That's
you.
it. Thank you.
Thank you very much.